Hashtag Boondox Trader Market Insights for Tuesday, July 28, 2026. Good morning, traders. This is the Boondox Trader Market Insights Daily Briefing, your edge before the opening bell. I am your host from the Boondox Trader Desk. Today we are covering the Fed's next move and why defined risk trades matter, unusual options activity in WULF, COHR, and TRMB, the chip sell-off and why smart money is still buying AMD and NVIDIA calls, earnings previews for ARM and Qualcomm, what to expect from Apple and Amazon this week, stress cracks showing up in private credit, and we wrap with the Boondox Trade of the Day bonus. Let's get into it. Hashtag navigating the Fed's next move. The Federal Reserve begins its two-day policy meeting today, with the rate decision due tomorrow. Futures markets are pricing in a high probability that the Fed holds rates steady, but the post-meeting press conference and the dot plot will move prices more than the headline decision. This is exactly the kind of week where traders can get chopped up trying to guess direction. A MarketWatch piece on Moomoo this morning makes a simple but important point. When the Fed is at an inflection point, defined risk trades can be a trader's best weapon. Credit spreads, directional long calls, and hedge structures let you express a view without betting the farm. If you are right, you capture most of the move. If you are wrong, your loss is capped. That matters more than usual when the market is waiting on Jerome Powell to either confirm the soft landing story or push back on rate cut hopes. The S&P 500 is essentially flat ahead of the meeting, with the Nasdaq slightly weaker and the Dow holding small gains. That is a market that does not want to commit before the Fed speaks. My read is simple. Do not force trades into a binary event. Wait for the reaction, then trade the follow-through. Hashtag unusual options activity, WULF, COHR, and TRMB. MoMa's options scanning caught 10 unusual trades in the last 2 hours of trading. The standouts were TerraWulf, Coherent, and Trimble. TerraWulf, ticker WULF, saw call volume of 2,298 contracts against open interest of only 22. That is a volume to open interest ratio of 104.5. The trade cost roughly $528,000 in premium, targeting the $17.50 strike expiring August 21st. TerraWulf is a Bitcoin mining name, so this is a crypto-related leveraged bet. Coherent, ticker COHR, had 927 call contracts trade against 11 contracts of open interest, an 84.3 VOI ratio. Premium spent was about $730,000 for the $272.50 strike expiring July 31st. That is a 4-day expiration, so this is either an earnings-related gamble or a very short-term technical breakout bet. Trimble, ticker TRMB, had 4,000 call contracts trade against 50 of open interest, an 80.0 VOI ratio, with nearly $1 million in premium. The strike was $60 expiring September 18th. Trimble is a positioning and mapping technology company tied to agriculture, construction, and autonomous systems. These are not trade recommendations. Unusual options activity tells you where money is moving, not whether it is smart money or dumb money. But when you see VOI ratios over 80 with real premium, it is worth knowing which names are attracting event-driven bets. Hashtag chip stocks tumble. But smart money is buying AMD and NVIDIA calls. The semiconductor sector has been taking a beating. The VanEck Semiconductor ETF has dropped sharply, and several high-profile names have given back double-digit percentages in a matter of weeks. Two drivers are behind the selling. First, investors are reassessing the competitive landscape. Second, they are questioning the AI investment model as enterprise ROI concerns keep surfacing. But options flow tells a different side of the story. A Moomoo community post this morning highlights that AMD and NVIDIA are drawing bullish call buying despite the sell-off. AMD saw the most notable bullish trade of the day. NVIDIA, even after a major market cap haircut, is still seeing institutions step in on the long side. The argument from the bulls is that this is healthy consolidation, not a broken trend. Big tech is still spending aggressively on AI. Demand for GPUs, high-bandwidth memory, and chip-making equipment has not collapsed. The real test comes this week when Microsoft, Meta, Amazon, and Apple report earnings. Their cloud growth and AI capital expenditure guidance will either validate the smart money bets or trigger the next leg lower. For credit spread traders, This means be careful selling premium and chip names right now. Implied volatility is elevated, which makes spreads tempting, but the directional risk is two-sided into earnings. If you want exposure, keep it small and keep it defined. Hashtag ARM earnings preview. Can an AGI CPU rescue the stock? ARM Holdings reports soon, and the setup is tense. The stock is trading around $266, sitting right at the gamma flip line for the July 31st weekly expiry. The put wall is down at $250, and the call wall is up at $300. That means the market is pricing a wide range and dealers are hedging around those magnets. Implied volatility is extreme. 4 rank is 86 and 4 percentile is 93. The put-call ratio is 1.13, slightly bearish. Traders are bracing for a big move, and the options market is tilted toward downside protection. The 3 things to watch are cloud AI royalties, licensing consistency, and whether ARM's AGI CPU supply is catching up with demand. A royalty result near $700 million would show that data center growth and higher ARM9 royalty rates are offsetting weaker consumer markets. But the bigger question is whether ARM can grow into a production silicon player while keeping costs under control. The community poll is 87% bullish, 13% bearish. The options tape is not quite that optimistic. Hashtag Qualcomm earnings preview. Is the handset trough finally here? Qualcomm reports fiscal third quarter earnings after the bell on Wednesday. The numbers are not expected to be pretty. Revenue consensus is $9.62 billion, down 7% year-over-year and 9% quarter-over-quarter. Non-GAAP net income consensus is $2.38 billion, down 22% year-over-year. The 3 key questions are whether the China inventory correction is ending, whether automotive growth can offset handset weakness, and when the data center business becomes financially visible. Automotive is reportedly growing near 50%, which is impressive, but it is still a small piece of the total pie. The data center opportunity is longer term and unlikely to move this quarter's numbers much. The option setup is more balanced than ARM. Qualcomm's put-call ratio is 0.92, with 4 rank at 63 and 4 percentile at 79. The stock is around $169, sitting just above the gamma flip at $159. The put wall is at $160, and the call wall is up at $190. That gives a constructive setup where dips toward $160 could find support, while upside drift has room toward $190 before hitting a magnet. Hashtag Apple and Amazon earnings. Big expectations. Apple and Amazon are both expected to report this week with double-digit revenue growth. Amazon reports Thursday after the close. Consensus revenue is around $196.2 billion, up roughly 17% year-over-year. Operating income consensus is $23.5 billion, right in the middle of company guidance. Amazon has beaten revenue estimates 7 quarters in a row and EPS in 9 of the last 10 quarters. The focus will be on AWS growth, AI CapEx commentary, and e-commerce momentum. Analysts are overwhelmingly positive, with an average target price of $320. Apple's fiscal third quarter revenue consensus is $108.9 billion, up about 16% year-over-year. EPS consensus is $1.89. The March quarter saw iPhone revenue hit a record $57 billion and services hit an all-time high of $31 billion. This week, watch iPhone 17 demand, services growth, any Apple Intelligence updates, and whether Greater China momentum continues. Analyst average target price is around $328. Both reports matter because they set the tone for megacap tech. Strong numbers could pull the Nasdaq out of its recent slump. Disappointing guidance could extend the correction into August. Hashtag stress cracks in private credit. Outside of public equities, there is a quieter story building that every trader should understand. The private credit market has ballooned to somewhere between $1.5 and $2 trillion. For the first time since that expansion, stress cracks are showing. Fitch Ratings says the private credit default rate hit 5.8% in January 2026, the highest level the agency has ever recorded and nearly double the 2025 monthly average. Consumer products default rates surged from 6.1% to 12.8% over 12 months. A big chunk of lending is concentrated in technology and software, the same sectors now facing AI disruption and valuation pressure. The private credit market is also opaque. Borrowers usually do not have public credit ratings, so problems can stay hidden until they suddenly break. The UK bankruptcy of Market Financial Solutions was a recent example. Regulators, including Fed Governor Michael Barr, have warned that stress in private credit could create psychological contagion, where investors extrapolate isolated private market problems to public corporate bond and loan markets. For now, high-yield bond spreads have remained relatively stable, and the stress looks contained. Lenders are tightening standards and increasing oversight. But this is a macro risk worth monitoring because if private credit stress escalates, it could tighten financial conditions faster than the Fed intends. ## Platform Spotlight, Moomoo Options Analytics. A quick reminder about the platform that helps me track a lot of this flow. Moomoo's options analytics, including volume to open interest ratios, unusual activity alerts, put and call walls, and gamma flip indicators, give traders a real-time view of where positioning is building. When the market is binary around Fed decisions and earnings, seeing where the big premium is going is a real edge. The paper trading simulator is also useful for testing credit spread ideas before you risk real capital. If you are learning to trade defined risk structures, that is a safer place to practice than a live account. ## Market Breadth and Index Snapshot. A quick look at the tape. The Dow is holding small gains while the Nasdaq and S&P are flat to slightly lower. That is pre-Fed hesitation, not a trend. Semiconductors remain under pressure. Software and internet services are catching a relative bid. Energy is moving on the Iran pause headline, and crypto is digesting the weekend relief rally. Implied volatility is elevated in individual names heading into earnings, but the VIX itself is not spiking. That suggests the market is nervous about specific events rather than systemic panic. For credit spread traders, that is a mixed environment. Premium is there, but direction is unclear. ## Boondox Trade of the Day bonus. For today, we are watching SPY for a 1-point credit spread opportunity after the market opens. The scanner runs after 9:30 Eastern when real options bid-ask quotes are available. Remember, every trade is paper only until proven profitable. Each trade is its own $100 account, with a $10 hard stop and a 50% profit target. With the Fed tomorrow and big tech earnings this week, be extra selective. ## Boondox Trader Closing Outlook. Here is my read as we head into the Federal. The market is coiled. Semiconductors are being repriced. Big tech earnings will decide whether that repricing is overdone. Private credit stress is a background risk, not a front-and-center crisis. Crypto is catching a bid on the Iran pause, but it still needs to hold $65,000 through the Fed decision. The best trade this week is often no trade. If you do trade, keep it small, keep it defined, and wait for confirmation after the Fed speaks. The trend will be clearer by Thursday than it is today. That wraps up today's Boondox Trader Market Insights. Trade safe, manage risk, and we'll see you tomorrow.